Okay. All right. Thank you guys so much for joining us today. My name is Roxanne, and I am joined today by Lauren. Lauren will introduce herself and tell you all about the great things at GreenPath. Excuse me. Just want to say thank you guys for joining us today. And Lauren, I'm going to go ahead and turn it right over to you.
Awesome. Thank you so much, Roxanne. Well, good morning, everyone, and thank you for joining us today for our presentation on building credit from scratch. As Roxanne mentioned, my name is Lauren Simon. I work at GreenPath Financial Wellness, and we are a nationwide nonprofit that provides financial education and tools to help people lead financially healthy lives. So we partner with Neighborhood Credit Union to provide this service to their members and to their potential members. And our goal in our presentation today is to help you have a better understanding of what credit is, how it can impact you, and ways that you can strategically and responsibly build a positive credit history. So we also invite you after the webinar is over to take advantage of a free counseling session with GreenPath Financial Wellness to discuss your unique financial situation and goals. This can include a lot of different things. We do personalized credit report reviews. We also can talk to you about reviewing or building your spending plan, talking about your credit history in more specific detail. We can discuss student loan options, and I know a lot of people have that on their mind now that those payments are coming due soon. And we can also help you explore options for dealing with any debt you have or any housing concerns or goals that you have. So during today's workshop, we're going to be taking a look at what credit is, why it's important, how to build credit, and I'm also going to bust some credit myths and talk about healthy credit habits to practice moving forward. So let's get started. Before going any further, we want to jump into the first big question, which is, what is credit in the first place? At its core, credit is an agreement between an individual and a creditor in which the individual receives something now with the understanding that they will pay the creditor back later. So this can come in a variety of forms, such as a loan, a credit card, or even a line of credit. Now, a credit report shows your credit history and the activity on all open credit accounts. This shows how you have handled credit accounts in the past, as well as how you're currently handling your credit. Things can typically stay on your credit report for between 2 to 10 years, if not longer, if they are open and in good standing. There are 3 credit bureaus that generate credit reports. They're called Experian, Equifax, and TransUnion. Now, it is very possible that there may be some differences between these 3 reports. Sometimes smaller financial institutions like banks and credit unions or collection agencies, they may only report to one bureau and not to all 3. So when you're reviewing your credit, it's very important to review all 3 reports. Now, you can access free copies of your credit report from all 3 credit bureaus at annualcreditreport.com. It is recommended that you do so at least once a year to review your credit reports for accuracy. Now, your credit report will typically include some personal information, things like your address and your employer, as well as the history and information about your credit accounts, bankruptcies, collection accounts, as well as a list of who has accessed your credit reports, which are known as credit inquiries. Your credit report does not include any information on your income, any assets, or savings that you may have. And your credit score is a 3-digit number that uses the information from your credit report to help creditors predict how likely you are to pay back as agreed if they choose to extend the credit that you're requesting. Basically, creditors use your credit score to measure how risky it is for them to offer you a loan or to give you a credit card with a certain available limit. Now, one thing is important to mention. Just because you have a high credit score, it doesn't necessarily mean that you're financially healthy. It is possible to have a high credit score while carrying a lot of debt and having no savings, just like it's possible to have a low credit score due to not having hardly any debt, but being financially stable overall. So just remember that a credit score is not an indicator of your financial health entirely. So there are 5 factors that make up and impact your FICO credit score. The largest of these is the payment history. Making every payment on time every month is one of the very best things that you can do for your credit score. The second largest factor impacting your score is the amounts owed, which includes your credit utilization. So when creditors are looking at your credit reports, they want to see that loan balances are decreasing, not hovering at a certain amount or increasing over time. This can sometimes happen with student loans or finance loans. Also, they factor in the number of accounts that currently have balances. Now, credit utilization specifically looks at revolving credit accounts, things like credit cards, where your balance could go up one month and down the next. Credit utilization looks at how much of your credit limit you're using. The more credit limit that you use, the more risk you are to a creditor, meaning that if you add up all of your revolving debt balances and divide them by the total of your revolving debt limits, that is your utilization percentage. Ideally, you do not want to use more than 30% of your credit limit at any one time. And with credit cards, it's ideal to pay them off in full monthly. The length of credit history looks at how long your credit accounts have been open. This includes the age of your oldest account, the age of your newest account, and the average of all your accounts. Typically, the longer your credit history, the better. Up next is new credit, which is also known as hard inquiries. So when you apply for credit, the creditor will typically do what's called a hard inquiry, which is where they dive deeper into your credit report and credit score to assess their risk. If you start applying for multiple forms of credit frequently, this can be a red flag to creditors because they start to wonder what is going on where you suddenly need a new credit card one month, a new loan the next month, and now another month later, you're asking for a new credit card. Now, of course, we typically all need to apply for credit from time to time, so that is understood. The key is being strategic with when you do apply and limiting those hard inquiries to only when you need it. Hard inquiries typically remain on your credit report for 2 years. And finally, credit mix is the last factor that impacts your credit score. Creditors typically want to see that you have a history of managing different forms of credit at the same time. For example, maybe a credit card and a car loan and a student loan. This is one of the smallest factors impacting your score, but it can have a well-rounded mixture. It can help to have a well-rounded mixture of types of credit when they're all managed responsibly. So if we add these all up together, this is where we get a roughly 100% of our credit score. So again, that payment history is 35%, and it is the biggest piece of what makes up your credit score. Now, while it is possible to have a 0 as a credit score if you have no history at all, and if there is nothing on the report that the minimum score typically would be 300, which is considered poor credit, all the way through 579. Once we hit about 580 through 669, this is considered fair. 670 through 739 starts being considered good, with 740 to 799 considered very good, and 800 plus falling under the category of excellent. Now, these are all based on the FICO score range, which is one of the most commonly utilized score models amongst creditors. The average score in the United States does vary a bit from year to year, but almost always falls somewhere in that good range of 670 to 739. So now that we've talked about what credit is and what it can impact, why does this matter to us? Why is credit so important? Number one, your credit history or credit score can impact your ability to rent or purchase a home and turn on utilities in your name. So, of course, we all need shelter and a roof over our head. So, it's important that we have a way to access this. Your ability to get and keep some jobs can be impacted by credit. Some jobs will require a credit check before the job offer is extended, and some will periodically review your credit throughout your employment. This includes, but is not limited to, military and security clearances. Credit can also impact your ability to open a bank account and, of course, to access loans or credit cards. There are also miscellaneous other things, including car insurance rates, cell phone plans, and more that can be impacted by your credit score. And even if you are able to get a credit card or a loan with a lower credit score, you may have to pay more to have access to that credit. Creditors may charge you a higher interest rate as a way to account for the higher level of risk they're taking by extending credit to you, considering that you have a lower score. So, for example, this is a chart of interest rates on a 5-year car loan for $20,000. I will say, I think we came up with this chart before some of the changes made by the Fed, because some of these rates are looking pretty good to me. But as you can see that the interest rates, the monthly payments, and the total interest paid varies dramatically between the poor credit score and the very good or excellent score. In fact, someone with a very good or excellent score would save more than $7,000 in total interest paid compared to what they would have paid if their score was poor. Again, interest rates have risen pretty dramatically in the last year or so. So this number is compounded by those higher interest rates. Now, even in this example, $7,000 is a lot of money. So this is a prime example of why building credit history, and specifically positive credit history, is so important. So how does someone establish and or build a credit history? So one of the first things I always want people to know is that building credit history absolutely does not have to mean that you're going to go into a bunch of debt. It is 100% possible to build credit history without carrying large debt balances and paying a lot in interest. So how can we do this? You know that you have to have experience to get a job, but at the same time, how do you get experience without being able to get a job? Credit can kind of feel the same way. Creditors do want to see some credit history to measure the risk level of extending credit to you, but how can you get that credit history without having credit extended to you in the first place? So, similar to getting an entry level job to start building job experience, there are credit building products that are specifically designed to help you start building your credit history with protections in place to help minimize the creditor's risk. One way to build credit is a secured credit card, which requires a cash security deposit to open the account. This security deposit reduces the risk to the lender because if you don't pay your card, they have the money from your deposit to pay it. People with no credit or with bad credit often must start with a secured credit card to build or establish credit. Now, these deposits are generally low, on average anywhere from $200 to $500, but they can potentially be higher depending on your lender. With a secured credit card, you are still required to make a monthly payment on time, or you risk it being reported late to the credit bureaus. Your deposit is not used to pay for your purchases, and you are charged interest on the balance that you carry over to the next month. So this is not a debit card. Another building product is a credit builder loan. The loan amount that you borrow is held in an account while you start to make payments on the loan. Generally, you can't access that money until you have fully repaid the loan. Essentially, you are building a savings while making payments to increase your credit score. There's no risk to the lender because if you don't make your payments, they haven't actually given you any money yet. It is important to make your payments on time, or you will see negative reporting to the credit bureaus. A similar product is called a certificate secured loan. If you have money in a bank, you can use it as collateral for a loan. Effectively, you're taking a loan against your own money. The money is frozen until you repay that loan. So, for example, you could have $800 in an account at your financial institution frozen, and you receive an $800 loan. Then you pay $80 for 10 months, and once it's prepaid, your $800 deposit is unfrozen. Now, this example, of course, excludes any interest. My guess would be maybe you'd pay something like $100 for 10 months, for example. Now, if someone you trust has a credit card in their name, they could potentially add you as an authorized user to start building some credit history. Typically, accounts where you are an owner have more impact on your credit, but being added as an authorized user can be a good way to start establishing some credit history. There is, of course, some inherent risk in this because if that individual maxes out the card or misses a payment, this can actually negatively impact your credit as well. But if you trust the person, this can be a good option to start establishing some credit history until you're able to get an account in your name. If you are in a situation where you have had credit history in the past and then life happened, your credit suffered, and now you're looking to rebuild positive credit, know that it is absolutely possible to do so. It will require some patience on your part, but many of the same strategies that we just talked about to build credit from scratch can apply to rebuilding credit after something like a bankruptcy, foreclosure, or repossession, or if you simply haven't used credit for 5 to 10 years or maybe even longer. If you're looking to rebuild some positive credit and you still have outstanding balances owed, prioritize getting those paid off. If you have collections or charge-offs, which is when an account falls far enough past due that the creditor begins attempting to collect the full balance owed instead of just the past due amount, which essentially is a collection account, then work on a plan to get those items paid off. The same credit building products we just talked about, secured credit cards and credit building loans, are good options to start rebuilding credit as well. Now, part of the reason that credit building can feel so overwhelming is that there is a lot of conflicting information out there, and some of the information just flat out is false. So let's take a look at a few of the most popular credit myths and talk about why they're not necessarily true. First, one of the most common credit score myths is that you have to carry a credit card balance from month to month in order to build credit. Not only is this not true, but it is a myth and it can actually cost you a lot of money. So when you get your credit card statement every month, there is a statement balance and a minimum payment due. To avoid a late payment, you need to pay at least the minimum payment due by the due date. However, if you pay only the minimum payment and there's a difference between that number and the statement balance, when your next statement cycles, you'll typically owe interest on the statement balance amount you did not pay. So for example, if your statement balance was $50 and your minimum payment due was $20, if you pay your $20, you've made your payment obligation. But when your next statement cycles, you'll be charged interest on your $30 balance that you carried forward. If you pay the full $50 statement balance, you will typically not be charged any interest. Now, some people believe that they must only pay the minimum payment and make sure that they're carrying a balance into the next month in order to build credit. And that's simply not true. I personally have never carried a balance on any of my credit cards just due to the way that I manage my credit cards, and my credit is in perfectly good shape. So I really encourage you to get into the habit of paying off your entire statement balance that you owe in full when you get your statement each month. This is going to save you a lot of money in interest charges and will help you keep your balances lower, which improves your credit utilization. And it's always important to remember that credit cards are not extra money. Ideally, if you charge something on your credit card, you want to have the ability to repay it either right away or by the time that statement arrives. Now, another myth is that all credit scores are the same. So there are two main scoring models that we tend to see, the FICO score and the Vantage score. Each model determines credit scores a little bit differently, and the scores ranges are not the same. Scores can vary dramatically, so keep that in mind. But one thing to know is that 90% of conventional mortgage lenders use FICO scores when determining creditworthiness and extending credit. Credit Karma, Credit Sesame, and CreditWise all use the Vantage score. So the majority of the time, if you are receiving a free credit score, it's likely going to be a Vantage model, unless your financial institution or credit card company provides you with a FICO score model. You'll be able to know what score you're seeing because it will list either Vantage or FICO with the score. For example, Credit Karma might say you have a 710, but when you go to apply for an auto loan at your financial institution, they might see a 660. If you really want to know an accurate FICO score, most of the time you have to pay for it. You can either go to the credit bureaus directly to purchase a score, or you can visit myfico.com. Now, the next myth is that while technically having more available credit limits can help improve your credit utilization, this can be somewhat of a dangerous game to play. So, when you open a new credit card, you're going to have a new hard inquiry on your report, and you're going to have a younger account in your length of credit history. And both of these things can negatively impact your score, especially in the short term. Also, the more credit cards you have, the trickier it can be to keep track of your due dates and make all of your payments on time. And there's more potential for you to get in over your head with your balances spread across multiple cards. So, while there's no magic number of cards that's best to have, typically we recommend no more than 2 to 3 cards. Some people also think that paying off a credit card, they should close it right away. It's important to know that this can negatively impact your credit score, especially in the short term. So you will lose the length of the history from that card, and it can impact your credit utilization. Typically, once you open a credit card, it's best to keep it open as long as you're managing that card responsibly. We talked about earlier reviewing your credit report and the differences in the credit score monitoring tools. We've also talked about how applying for credit leads to a hard inquiry, which can start to negatively impact your credit score. So, some people believe that checking your own credit score will hurt your credit score. It's important to know that there are 2 types of credit inquiries: a hard inquiry, which is when a creditor or lender typically does a deep dive into your credit history to measure the risk level of extending the credit that you're requesting. And the hard inquiry indicates that you've applied for credit. And as we discussed earlier, it can, begin to negatively impact your credit score if this is done too often. Now, when you check your own credit for educational or monitoring purposes, this is called a soft inquiry, and it does not impact your credit score. It's really important for you to review your credit reports and keep an eye on your credit score so that you can react quickly if you notice fraud or if something just doesn't seem right. The good news is that it is free to do this on annualcreditreport.com, and you can do so without a concern of it impacting your credit score. So now we're going to talk about some healthy credit habits. It's really imperative that once you get access to credit, you practice these healthy credit habits to ensure that you're building positive credit history. So before we wrap up today's discussion, there are some important tips on healthy credit habits to practice, whether you're starting from scratch or you're trying to rebuild a positive credit history. As we discussed earlier, payment history is the largest factor that impacts your credit score. Missing or being late on just one payment can have a quick negative impact on your credit score, and it will take a while to build back from that drop. This is why it's so important to make sure that every payment is made on time every month. If you are at all concerned about keeping track of due dates, I recommend setting up automatic payments so that you can make sure your bills are paid on time every month. We also mentioned credit utilization, or where your credit card balance is compared to your maximum limit. And this is the second largest factor that impacts your credit score. Strive to always keep your balance below 30% of your credit card's maximum limit. And if you can keep it below 10%, that's even better. Ideally, pay your cards off in full every month. Maybe you could try picking one specific small budgeted expense to use your cards for every month. Maybe something like putting some gas in your car, or even better, a subscription service like Netflix. Use the card just for that purpose and keep the balance low, and then pay off the full balance when you get your statement for the month. This is a great way for you to build positive payment history while keeping a low balance and avoiding interest if you pay the full statement balance off monthly. Now, of course, most of us are going to need to apply for credit from time to time, and that's understandable. Be sure to be strategic when you do, however, instead of frequently applying for accounts which you don't need, maybe things like retail or store cards, as this can negatively impact your credit. Now, if you do want to shop around for the best rates on something like a mortgage or a car payment, try to get all your ducks in a row and apply with multiple lenders in a short period of time. And these types of inquiries will only count as one hard inquiry instead of multiple. We usually recommend doing this within a 2-week period. This allows you the opportunity to shop around for the best deal without having a more significant impact to your credit score. Collections can stay on your credit report for up to 7 years and can have a big negative impact on your credit score. Collection accounts can include everything from unpaid car insurance, cell phones, cable equipment that wasn't returned, medical bills that went too long without being paid, broken rental leases, and more can be sent to collections, and they weigh heavily on our credit. Now, some people ignore collection accounts because they think they should not be paid because the bill was already paid or maybe there was an error. It's important to take care of this as soon as you get a past due bill or notice, because ignoring it doesn't mean that you don't think it is legitimate typically. And these things don't magically go away, but it can be much harder to take care of down the line. So, again, if you receive a bill that's incorrect, be sure to work with that creditor right away to get the issue resolved before it's sent to collections. Review your credit reports from annualcreditreport.com annually to ensure that everything looks correct and that you're aware of everything that is being reported. Remember that checking your own credit report and/or score does not impact your credit score. You're reviewing it for educational and monitoring purposes, and this is different from a hard inquiry, which would impact your score. Now, it's important to know that credit scores are not part of your free credit report. You may be familiar with some of the online tools like Credit Karma that offer free credit scores. While these can give you a rough idea of where your score may be, it's important to take that score provided with a grain of salt, as it's typically not going to reflect the type of score that a lender would provide. If you were to go to your credit union or bank and apply for credit, there's a good chance that the score they pull is going to be different than what you see on Credit Karma. You can talk with your financial institution or creditor to see if they have free credit score monitoring available. That's more common nowadays. So if you'd like to do that, you can take advantage of those offers. And finally, I don't know if I've said it enough, so I'm going to say it one more time. It's important to make your payments on time every month. This is really worth repeating because it makes a very big difference when it comes to your credit. If you're at all concerned about not being able to pay on time, reach out to your creditor. Many times they can make a due date change for you or give you a little bit of grace so that you don't have to have a negative impact on your credit. So this kind of wraps up my advice on improving and building your credit scores today, but I do want to give you all of the contact information where you can get some more information. First of all, if you do want to speak to GreenPath at all, we have financial wellness experts that are ready and waiting, both in English and Spanish, and you can give us a call at this 877-337-3399 number. They can do a personalized review of the credit report for you. We are able to do soft inquiries on your credit, so they're educational in nature. They do not impact your score, but they can give you specific advice for what you're working on towards your goals. We also have a website with Neighborhood Credit Union. It's greenpath.com/neighborhoodcu. You can log on to that website to learn more. There are some articles and guides on credit on there, as well as a variety of other financial topics. We also have financial education courses available on that same website. If you click on the Learning Lab Plus icon, you'll be able to complete some courses, and there are some in there on credit if you are interested in learning more. So we'll go ahead and take some questions now today, and I think Roxanne will probably do the trivia question as well when we're ready for that.
I will. Let's see. Are there any questions though? Thank you so much, Lauren. That was very informative. Always good information coming from GreenPath. But if there's any questions, we'll answer those now. Okay. Looks like we are good. I am going to go ahead and stop the recording now.